very much for this kind introduction. Thank you all for being here, and thank you, CEIBS, in particular, for affording me this great honor to participate in the forum. I have been asked to talk to you about a very interesting and difficult question of whether China real estate is in a bubble. So I will take a crack at that, and of course, will do my best to give you the rationale for my thinking. So I thought a good place to start would be to ask, well, how do bubbles form if we're going to try to decide whether we are in a bubble or not? Well, a bubble is a period in which fundamentally valuations are at a level that is not sustainable, unsustainably high level, driven generally by rampant or massive speculation, as opposed to fundamental value principles. Generally, in a bubble, things will not be driven by the most economic fundamentals, such as cash flow, free cash flow, rental incomes, but rather by other non-economic factors. The trouble with bubbles, though they can be fun while they last, is that they do contribute to a bad allocation of resources. And when they do burst, which they always do, they will have broad and adverse economic impact. So how do they form? We've seen enough of them over history that I think we have a pretty good sense of what happens. Generally, you start with unrealistic forecasts of future value and future value drivers. I think an easy example to understand that many of you will remember is the internet bubble, where fundamentally financial analysts wanted us to believe that the value of internet companies was driven by the number of people who clicked on your website. People really called them eyeballs, as opposed to the cash flow that was generated by visitors to your website. Of course, that leads to people being overconfident in the value of these companies. They start to buy these assets based on non-fundamental principles, and then they tell their neighbor about it. I bought AOL at $10 this morning, and I sold it at $15 this afternoon. I made 50% return in one day. So, of course, what does my neighbor do? She doesn't want to be seen as less smart than I am, so tomorrow she buys AOL at 15 in the morning, sells it at 30 in the afternoon, and then tells her neighbor about it. And it sounds like a joke, but that really is how it went between 1998 and 2000. People were overconfident, and then there was this massive amplification of this effect, the group amplification. Of course, invariably, something happens. That something could be literally as simple as one analyst with some credibility, some following, saying something doesn't make sense. It could be one company that people had a lot of confidence in running out of money and going bankrupt. Many of you remember another famous case in the U.S., the case of Enron. That itself was a bubble. And literally one thing that started that bubble popping was one earnings announcement where the CEO lost his temper because one of the analysts was asking difficult questions. The CEO literally called him a word that we don't use in a public setting. And that got a lot of analysts thinking, wow, if Jeff Skilling is losing his temper, something must not be right. People start to dig deeper, and invariably you have a very painful, difficult recalibration. And typically with these bubbles, the recalibration is sudden and rapid, as opposed to a gradual decline. So when we ask if the real estate market in China is in a bubble, what are we really saying? For one thing, as we see it from today's forum, it's not a homogeneous asset class. We've talked a lot, and I think for very good reason this morning, about low-income housing, so we could talk about housing more generally. We're going to talk this afternoon about commercial real estate. Those are very different asset classes. So I would like, if I may, to focus on the real estate sector, and I know we'll have a chance in the afternoon panel to talk about more more broadly the commercial sector. So two questions in trying to understand whether prices are unsustainably high in China. What drives prices, and what factors make them sustainable? Well, one of the issues to be careful with is the data. People can interpret data in many different ways, and I want to raise a question with you about whether the data is in fact evidence of a bubble or whether it's evidence of selective analysis by many analysts. In particular, I'm focusing on Western analysts. This, I think, is a good example of what I'm trying to say. If you look at this chart, you see two things. You could see that prices have gone from something like 70 to 180 in the span of 7 years. That's a huge rate of increase. So people can look at that and say, well, we're in a bubble. Well, if you look at a broader set of data, more cities, you see, in fact, the increase is substantially less pronounced. So are we looking at the right data? Are we picking one city where there may be economic fundamentals, and I will show you some data that suggests that there is, and saying, we're in a bubble because prices have risen? The second factor about what I'm calling selective data analysis is that I would go as far as to say you have to be extremely cautious when people try to argue things, particularly bubbles, only using indexes. Indexes show you the rate of change, and that's an important factor. But indexes don't tell you the actual level of value. It may be that assets were substantially undervalued at the beginning of a period, and that after a rapid increase, they are more fairly valued. So one point I would like to make at the outset is be careful how you interpret or how you let analysts interpret the data for you. You have to dig deeper than a nice picture and somebody's statement. Let's go on and look a little bit more data. So this data shows you the ratio of price to rent for housing stock in 8 major Chinese cities, Chinese markets. You see a number of things from this data. One thing that you see is there is one outlier. The green line is Hangzhou. Now, obviously, I'm not the expert, but I'm told Hangzhou is paradise on earth. So there may be factors that drive the value of real estate in Hangzhou beyond literally the price-to-rent ratio. It may be that assets there are not driven by what you can collect by renting them. So again, it's very dangerous to take price to rent, plot it in a market that may not be driven by price to rent, and say, see, we're in a bubble. The other factor I would point to is the consistency with the rate of increases of these markets across a fairly decent, not a long period, but we're looking at almost 4 years of data here, during which this bubble is supposedly forming. And I would say, I will show you some data from bubbles in a minute. I would argue that this rate of increase is far less violent than one would expect in a bubble. The last thing that I have to point to as well is that these ratios are certainly far higher than the ratios we've seen in Western markets. And I will, again, show you that data in a moment. But just remember for a moment, the range here is between somewhere around 17 to about 32, 33. So the midpoint is about 25 times price to rent at the beginning of the period, 2007, and today, 2010, we're somewhere around 35. That means if something is worth rents for 10,000 units of currency, or it is likely to be worth 35 times that in the market. So the crude trend line, as I was just saying, you can see it in English, but you can't see it in Chinese. The crude trend line goes from about 25 times to about 35 or 37 times. There it is in the Chinese slide, okay? So the question then, if somebody is paying 35 or 37 times the rent equivalent for a property, does it mean the price is too high? Or does it mean something else? Well, one thing it could mean is maybe the rents are too low. And there may well be reasons in the Chinese environment to explore that. take a look at this further data. Again, many analysts take a look at this and say, see, we're in a bubble. What are we looking at? The top line, the thin blue line, that's China. And again, that's the rate of increase of the ratio of price to rent. So many analysts look at this and say, see, the rate of price to rent in China has gone from 100 to 150, whereas in Western markets, the US, UK, and Europe, it's gone up and then it went down, but it really only went from 100 to something like 120 and back down. Some people will say bubble. I don't agree with that. Again, for the reason I've cited, which is even though the index has gone up, we need to dig deeper and try to understand two things. Are the levels inappropriately high? Are the levels unsustainably high? What is driving those levels? So just looking at index data could certainly, in my view, be very misleading. The other factor, again, is are the rents possibly too low, which would certainly explain why those ratios are completely out of sync with the Western markets. Well, what drives supply and demand imbalances? Take a look at this data. This shows that between 1990 and 2009, so almost the present time, we went from 300 million people in China living in urban areas to about 600 million. That is literally as if the entire population of the United States moved in to urban cities in China. I can honestly say that is probably difficult for your average American analyst to understand, or Western analyst. That is literally the size of Europe moving into a handful of urban cities. Of course that is going to drive supply-demand imbalances, and of course that is going to have an impact on prices. If rents are not keeping up, of course you're going to see the ratios of housing prices to rents increase dramatically over that period. In terms of rate of urbanization, we see that the rate went from something like 22% over here to 45%. That is a massive change in the demographic. In terms of actual cities that have taken in this massive influx of population, the top two leaders in change, if you will, and remember those two cities because you'll see a parallel with the prices in those two cities, are Beijing, where we've had a 53% increase in the population in 10 years. I think I can fairly say no Western cities would dream of that. And the second highest at 40.9% is Shenzhen, where we are here today. So remember those two, Beijing and Shenzhen, have had the most pronounced influx of population over the last 10 years. So prices have, in fact, risen, but it is not clear, based on this massive population influx, that they are not sustainable. It is not clear that they are unsustainably high. And if the rise is, in fact, real demand-driven, as opposed to speculation, and as I said, rents have yet to catch up with this massive demand, then quite possibly the rises are economically sound and natural. I'll just pause a second and give you anecdotes from the U.S. real estate bubble that we witnessed over the last 4 years. Large parts of the demand was speculators who owned multiple units in cities they had literally never visited. So that's quite a different dynamic than an owner-occupied home because you're moving from a rural area to an urban area. So I've shown you a lot of data. I think it's fair to step back a bit and ask a key question, which is, can anyone tell a bubble when they see one? So I talked a bit about how they form. I showed you what I think is interesting data. But how do you know if you're in a bubble? I'm going to show you a couple of interesting charts that I think will answer that question. This is a UK housing prices as a multiple of average earnings going back 50 years, 1952 to 2002, 50 years exactly. You see that on average, people buy homes, can afford homes, the value of which is about 3.6 times their earnings. Does this make sense in the Chinese context? So if I earn, let's say it's 100,000 RMB per year, I can be expected to be living in a home, assuming I own my home, that is worth 350,000 RMB. That's the ratio over a long time. Now, what's interesting is, as with all things economic, it's never steady. It goes up and down, up and down, up and down. Another interesting thing is whenever it goes back to the mean, we call it reversion to the mean, it never goes to the mean, it always overshoots the mean. The third thing to keep in mind is that it really does seem to go back to the average. It goes up and down, but it really, over the long term, is pretty steady at 3.6 times in the case of England. What happened between 2002 and 2004 is we went from the historical 50-year average of 3.6 times to about 6 times. If you're a statistician or if you're interested in probability and statistics, you might say that is 3 standard deviations away from the mean. Basically, that is something that's never supposed to happen in one's lifetime. I say in here 1 in 100 plus years. It's really more like 1 in a million years. It shouldn't happen. Now, what do you think people were saying in 2004, 5, and 6 when we were seeing this? They were saying to people like me who went around lecturing saying this is unsustainable, they were saying you don't understand. This has changed. People are buying real estate for different reasons. And you say, what might those reasons be? Well, some people said, you know, there's a lot of Arab money that likes the UK. They like to own homes in London. Well, if you think about it, the data is not just London. It's not just a couple of blocks around the palace in London. There's much more data than that. And clearly to blame this kind of behavior on a few Arab princes buying land or homes in London is what was creating this overconfidence and this mass amplification that I was talking about. So this looks unsustainable to me. Let me show you 2 more charts. This is the same data for the US. Same phenomenon, same time period. The markets were getting ahead of themselves. And again, people were saying, you don't understand. Famous words that I love to repeat, paradigm shift. I hope you can translate that into Chinese. I don't think it means anything in English, by the way, either. Paradigm shift means that the world has changed. Well, the world really doesn't change in a year or 2 or 3. Interestingly, the US average has always been slightly lower than the UK average. We've always been at 3.4, whereas the UK had been at 3.6. So between those two, let's call it 3.5 for purposes of remembering. The next chart I want to show you is going back to multiples of rent. The last 2 I showed you were multiples of income. Again, if you look at the data as a multiple of rent, you see that for a long, long time, it went up and down, but always reverted back to about 19 times, 19 or 20 times. In fact, 20 times was 1 standard deviation away from the mean. Well, that's a lot of preparation for what I really want to show you. What happened to this data over the next few years? Again, the average is 19 times. Can we show the 19 in Chinese? Yeah, that's the 19. That's the average. And the 2 standard deviation, which is supposed to happen only once every 40 years, was about 21. Well, by 2007, late 2006 really, we were trading at 32, 33 times. If you look at the standard deviation being 1, standard deviations really means 2/3 of the events are supposed to be within this range. So you're looking at something that was about 11 standard deviations away, which you can't even compute the probability of that. Think of it as 0. It's never supposed to happen. Maybe a million years wouldn't do it. And by then, the average had moved up from 1.3, the standard deviation had moved up from 1.3 to 3 times. Well, I don't think I'm going out on a limb if I say this is a bubble. Even with sitting there at the time, many financial analysts were saying, we are clearly in a bubble, it's unsustainable. The only question is, when will it pop? And you know what happens to bubbles. They do this, and then they crash. So this is the actual data of what happened between 2007 and 2009. So I think all the efforts now in terms of getting a little bit off the point of the policymakers in the West is to prevent the over-adjustment that you typically see. So right now we're really just back to the mean, and I think there's all this economic policy you hear about is really trying to prevent us from going far deeper, which is typically what happens. The problem with this is that not only a lot of wealth is lost, but it's really lost by the wrong people, if you will. Because the people who buy at the peak, who buy when it's going up from 19 times, 20 times, to 25 times, to 30 times, are the small speculators who have no idea what they're doing with their money. They are literally getting carried out by this hype, by this mass amplification I talked about. They are literally borrowing, people were borrowing money well beyond their means, and those are the ones who are going to lose their homes, their assets, their wealth in this process. So it's not okay to say, well, look, it just went back to where it should have been. The trouble is there's a massive reallocation of wealth to people who really couldn't afford to take those risks. So bubbles are incredibly disruptive. But back to China, do we see that kind of behavior in the data? And I honestly don't see it. Again, if you look at the 2 outliers in this chart, which is the price-to-income ratio in 8 major Chinese cities, the 2 cities that you could raise a question about are Beijing and Shenzhen. Now you remember in the chart I showed you with the urbanization, what were the 2 top cities in terms of urbanization? Beijing and Shenzhen. So I think it's easy to see that while, look, the multiples are clearly higher than in the West, and that's what gives a lot of analysts pause. People say, well, how could things be trading at 7 times rent when you saw in the US and UK the long-term average is 3.5 times? And it's also easy to see why certain economists, such as the IMF in particular, says there may be bubbles forming in certain cities, Beijing and Shenzhen being 2 candidates for that. I think there's enough fundamentals in this massive demand shift, and there's enough evidence that the market is really fairly orderly still, that I don't see the kind of data that I showed you a minute ago with the US and UK charts, where we were clearly in a bubble that you were never supposed to see in a million years. If you look at similar data with price-to-rent ratios, same thing. The crude trend line is that, yes, the rates are increasing, and yes, those are substantially higher than the multiples we're used to in the West, where the long-term average for rent, price-to-rent in the West is 20. The averages here are 25 to 35. But I think it's very shallow to look at that and stop and say, aha, we're in a bubble. Said another way, if we're in a bubble, we've been in a bubble in China for at least 5 years, and bubbles rarely last that long. I think one last data chart, and then I'll summarize with some thoughts. This is, again, arguing that while the level of price to rent is higher in China, the historical trend is not going up. The purple is China here. You see it's really fairly steady relative to the West. The US, UK, and Europe is the solid blue line. That's the one that has gone up and down. So if anything, the data would support the theory that, yes, we're at a higher level in China, but the rate of increase has not changed over those years. I would propose a few more bits of evidence that, in fact, what you are seeing in China is a more orderly market than a bubble. More recently, we've seen reports that prices have flattened out, and in fact, there's some argument that prices have come down moderately of the order of 5%. That's comforting for two reasons. Bubbles really usually pop, as I showed you in the very early slides. You don't see adjustments of the order of 5%. And the second point I would make is that since about almost 2 years ago, January 2010, the government has started to introduce measures to reduce speculation and reduce the number of transactions, and that also seems to have dramatically slowed the increases in prices. Here's the actual data for that. On the left, you see that prices in the last period are down about 4.8%, 5%, which again is very comforting as opposed to seeing a price drop of 30%. And on the right, you see the volume of transaction is down quite a bit, substantially less volume, which would indicate very little speculation. Because in a bubble, people are really selling to each other, if you will. I sell to you, you sell to your cousin sells to his friend sells to me at a much higher price. We all think we're richer buying and selling the same properties or very similar properties over and over again. That certainly does not seem to be happening here at all. So let me recap a bit. What do the charts and the data tell us? What do they not tell us? Do we have any agreement between the experts? What are the arguments for a bubble? What are the arguments against a bubble? And then I'll summarize and give you some implications. The charts do tell us that Western analysts love to claim that China's data is unreliable. A lot of the articles you read say, oh, we need more data, China's data is not reliable. I submit to you that the data may need to be improved, for sure it does, but there's also a problem in analyzing the data. I think you really need to dig deeper and understand it better. Another question I would put for you, to you as an example of analyzing the data is you look at average home prices and average incomes. Well, what makes us think that the average home is owned by the average Chinese earner? That is really a typically Western model because ownership rates are so high, you can fairly assume that there is a relationship. But if you think about it, if home ownership rate is far less in China at this point, given the economic history, then if you look at home prices and compare it to average wage earners' incomes, you are literally comparing apples to oranges. So that's why I think it's important not to get carried away and say, 3.5 in the US, 7 in China, bubble. I would say that's not clear. You really need to understand, well, who actually owns those homes? Is their home ownership driven by their income, or is there some other fundamental asset wealth that is not showing up in the data? Could there be other sources of funds to buy these homes? So it's very dangerous to just look at the data and then analyze it with a Western lens. Again, averages can be misleading and dangerous. What do the charts not tell us? Are there other possible non-bubble explanations for the high price-to-income and price-to-rent multiples? I believe I've just put at least two plausible arguments for you. One being the dramatic shift in population and resultant demand, the other being the fact that the data does not really correlate between home ownership and wage earners. Do we have a consensus among the experts? The answer is no. The opinions are mixed at best. The National Bureau of Economic Research, which is really a very highbrow think tank in the West, has economists who just want to believe there's a bubble. The Economist, which as you know is a very highly regarded magazine out of the UK, says there's not a bubble. And the IMF, which loves to please everybody, says, well, there may be some bubbles in some cities. The government does seem to be concerned. They seem to realize that some markets may be overheating, and by government I mean the Chinese government, and that's why they have initiated some policy measures to cool certain markets, which I think are very wise measures. So to summarize, the arguments that a bubble does exist is that the rise in price-to-rent and price-to-income ratios is there. There's been a rise, but I question whether is it risen faster than population shifts and whether it's unsustainable. Price-to-rent ratios imply buyers are expecting large capital gains, because if you're willing to pay 30 times rent, why wouldn't you just rent? Well, the answer typically is, I think I can sell it at 35 times. So there is a worry that means there's an expectation that prices are going to continue to rise, which is one of the factors that can lead to a bubble. And there's also anecdotal evidence of buyers going beyond their means, leveraging up, borrowing from banks or from family, and builders delaying sales because they think they can get more in the next month or next year. So those are the evidence for a bubble. There is some evidence. I question how powerful the evidence is. On the other hand, there's also arguments against the bubble. One is the rapid urbanization, rapid income growth, together with lack of investment alternatives. The stock markets are not as developed as they are in the West, so that's arguments to support higher prices. Other China-specific factors, such as under-measurement of income, as I said earlier, the correlation between home ownership and income may not be a wise correlation. Higher savings rates than in the U.S., so people are willing to put up more money to buy property. Lower taxes, lower cost of living relative to other economies, all of those factors may support those higher price-to-income multiples. And other local factors may also contribute to the supply and demand imbalance, such as the lower starting point for home ownership rates. Let me take a show of hands here. How many of you in this room believe we are in a bubble? Nobody raises a hand. That means it's zero. One or two. Very few. How many believe we're not in a bubble? Otherwise, the data would be inconclusive. How many don't know? How many say, look, it's very hard to know? Yeah, about the same. I think it's hard to know with certainty, but I do go out on the limb and I say I do not believe that the data would support the bubble. I believe the data does not support the conclusion that we are in the Western Star bubble or anything similar to the 2007-08 U.S. bubble. Now, should we care? I think we should, and I think policymakers do care, because if you're in a bubble, it really does have broad implications. A national bubble would be very severely disruptive. It would lead to massive destruction of wealth, and again, in the wrong places. It's not the speculators, the developers that would lose money. It's really the smaller investors, the private individuals who are sucked in by this massive excitement that would lose the most. And that could be socially quite destabilizing and disruptive. The other reason to care about bubbles is markets always overshoot in both directions. So when there's a correction, you end up going way below fair market value, fair value of the property, and that's also disruptive. And it's not just real estate prices that are affected, but economic activity can and does come to a grinding halt in the wake of a broad bubble bursting. It would not be limited to real estate. You could imagine the cement industry, the steel industry, all those would be deeply affected. And of course, those are core to the economic engines in China. So it is something to worry about. Local bubbles, on the other hand, if you have a bubble in one or two cities, are not nearly as damaging systemically compared to other economy, to other systemic bubbles. I think another factor is that China does seem to have lower exposure to mortgages, and individual savings rates are much higher, so at least that would mitigate the effect of a deep bubble. Let's talk a minute, I know I'm a bit behind schedule here, let's talk a bit about policy options in the West and then to the extent to which they might be relevant to China. There are really two major policy options that Western governments have tried to bring to bear in dealing with bubbles: interest rates and fiscal policy, taxes namely. The trouble with interest rates is it's a very blunt instrument. You don't control interest rates for real estate. If you raise interest rates, the whole economy suffers. And the trouble with fiscal policy as a means of controlling bubbles is more often than not it has created bubbles. A big case in point is that in 1980-82, when President Reagan was just elected and the economy was in deep distress, he gave massive tax incentives for real estate developers. Basically, you could depreciate for tax purposes your property very quickly and recover your investment very fast. Well, that, of course, led to a massive real estate bubble, which burst 10 years later, 1990-91, and that came at a huge cost. So government intervention is not does not always have the desired effect. Another government intervention that backfired is after the 9/11, the September 11 attacks on the World Trade Center, when economic activity really slowed down in the U.S., the central bank reduced interest rates quite dramatically to encourage economic activity. The trouble is they kept them low for very long periods, and that certainly helped fuel the second real estate bubble that we just talked about. So beware of government intervention. It can cause more problems than it's worth, at least in the West it has. And you remember famous words from Alan Greenspan, our federal bank chairman, our central bank, Federal Reserve chairman, when he talked about irrational exuberance in respect to the internet bubble. He clearly believed he knew we were in a bubble. He was talking about irrational exuberance, but he really couldn't do anything about it. He was trying to talk down prices, but we know what happened. That didn't change anything. The bubble kept going, and eventually it burst. So a number of bubbles that a lot of people could foresee, but the government really was not able to deal with them. 1983 biotech bubble, 88-90 real estate bubble, 98 to 01 internet bubble, and then the most recent housing bubble. So the reason we've tended to fail in stopping these bubbles is, one, it's very difficult to know before they pop whether it really is a bubble or it's just really fair market forces at work. Two, policy tools tend to be blunt. Again, if you raise interest rates to slow down housing prices, you're going to slow economic activity across the board. And maybe three, and most important, and one you don't have to worry as much about in China, is our politicians love to be reelected. And when you're in a bubble, everybody's very happy. It's like a party and you're serving a lot of alcohol, and if you're trying to stop the bubble, you say, cut off the beer or the wine. You know, the partygoers don't like that. So it's very difficult for policymakers to stop bubbles once they get going. The wiser thing, and I think you are seeing it here in China, is to prevent them from happening. Of course, when you're preventing a bubble, you're taking some risk because you're in effect acting before the bubble becomes dangerous. But that is precisely what a courageous government would do. And in fact, we have seen that here, as I said. We've seen tightening of lending requirements, increasing the down payment requirements from 40% to 60%, which is wise, barring certain state-owned entities from investing in real estate, and talking down prices. We've also seen a dramatic rise in interest rates over the last couple of years, from 0.8% in the short term to almost 4%. Again, the central authorities trying to reduce speculation. And so in conclusion, I do not believe the data supports a broad-based bubble claim. A few markets may be overheating, but that may be more driven by shifts in underlying demand. As such demand slows, so will price increases, so the market should not expect these prices to rise forever. But that is fundamentally different dynamic from a systemic bubble. If you're trying to learn from the West, be careful. The West has not had great success stories at preempting bubble. If anything, more bubbles in the West were caused or aggravated by erroneous government policies. And Chinese policymakers appear quite vigilant and willing to manage the markets in ways that may prevent systemically dangerous bubbles from forming. With that, I thank you very much.